There's this one line on a graph that has a spooky reputation for predicting recessions. It's a bit of financial jargon that can send shivers down the spine of Wall Street. Well, today we're going to pull back the curtain and decode the yield curve. So let's just ask the big question right up front. Can one single graph really predict a recession? I know, it sounds a little like financial astrology, doesn't it? But for decades, this one chart has had this almost mythical power, acting like a warning bell for economic downturns right before they hit. And that famous indicator? It's called the yield curve. Today, we're going to break down exactly what it is, how it's built, and why even a tiny change in its shape can send shockwaves through the entire global economy. This quote right here, it gets straight to the heart of the mystery, the inverted yield curve. That's when the line on this graph literally flips upside down, and it puts everyone on high alert. Our job today is to figure out why. Okay, so before we can really understand the curve itself, we need to get a handle on its three basic building blocks, and it all starts with something called bonds. First up, government bonds. The easiest way to think of a bond is as a formal IOU. You lend the government some money, and they promise to pay you back down the road, with interest. And because they're backed by the full faith and credit of the government, they're considered super, super safe. They're really the bedrock of this whole thing. Next, you've got maturity. This is just a fancy word for the length of the loan. Are you lending your money for just a few months? Or are you in it for the long haul, like 10, 20, even 30 years? That time frame, that's the maturity, and it's absolutely crucial. And finally, there's yield. This is the good part. It's your reward. It's the total return you get for lending out your money, usually shown as a percentage. This is the actual number we're going to plot on our graph. So just remember those three things: bonds, maturity, and yield. Those are our ingredients. All right, now that we have our building blocks, we're ready to actually make the curve. We just take the yields from bonds with all those different maturities and plot them on a graph. And what you see in a healthy, growing economy is what we call a normal yield curve. So what does normal actually look like? Well, it means the curve slopes upward. See, in a good economy, you would naturally want a bigger reward, a higher yield for locking your money away for a longer time. The longer the loan, the bigger the payout should be. Makes sense, right? And this chart shows it perfectly. You can see it so clearly here. The short-term bonds have a low yield. As you go out to mid-term and then long-term bonds, the yield and that bar just keeps getting higher. This nice upward slope is basically a picture of economic optimism. You get paid more for taking on that longer-term risk. But here's the thing. This curve isn't set in stone. Not at all. It's like a living, breathing barometer for the economy, and it's constantly being bent and reshaped by a few really powerful forces. So what actually moves it? Well, what investors think is going to happen with growth and inflation is a huge one. Then you've got the central bank, which can directly yank the short end of the curve up or down with its policies. And, of course, there's just the overall mood of the market. Fear versus greed, that can pull and push the whole thing into new shapes. And sometimes all those forces push the curve into a very, very strange and very telling shape. We're getting back to our main mystery now, the inversion. But before the curve goes completely upside down, it usually does something else first. First, it starts to flatten out. That gap between the short-term and long-term yields just shrinks and shrinks until they're almost the same. A flat curve is basically a sign of hesitation. It's like the market is holding its breath, getting nervous and uncertain about what's coming next. All that earlier optimism is gone. And then this happens. Inversion. The curve flips completely on its head. Just look at this thing. Now, short-term bonds have a higher yield than long-term bonds. This is financial common sense turned completely upside down. Why on earth would you get paid more for a short loan than a long one? This is the market basically screaming that something is deeply, deeply wrong. Which brings us to the most important question of all. Yeah, it looks weird for sure, but what's the logic here? Why is this specific upside-down shape such a scarily reliable predictor of economic trouble ahead? Okay, so let's walk through the logic, step by step. First, investors as a group start to feel that trouble is on the horizon. They see a slowdown coming. Step 2, because of that, they start betting the central bank is going to have to slash interest rates to try and save the economy. So step 3, they all rush to buy long-term bonds right now to lock in today's higher yields before they disappear. And finally, step 4, it's just simple supply and demand.
This massive rush of buyers for long-term bonds pushes their yields way, way down. So far down that they actually fall below the short-term yields. And boom, that's your inversion. It's like a self-fulfilling prophecy, all driven by fear.
But it's really important to understand this. While it's famous for being a recession predictor, the yield curve is so much more than that. It's like a daily checkup on the vital signs of the entire financial system. Think of it like a master dashboard. In one glance, it tells you what the market is thinking about future growth and inflation. It gauges the overall level of fear and confidence out there, and maybe most importantly, its shape has a direct impact on the interest rate on your mortgage, the loan a small business needs to grow, and even the credit card rates we all pay. It is truly foundational to everything. And that's really the magic of it all, you know? It takes the complex opinions, the fears, the hopes, and all the math from thousands upon thousands of investors around the world, and it distills all of that collective wisdom, or collective panic, into one single elegant line on a chart. It's the market's best guess for our economic future. Which leaves us with one last thought. Now that you can read the signs, the steepness, the flatness, the inversion, you have the tools to look at the yield curve right now and to code its message for yourself. So the real question is, what is it telling you about the road ahead?